the capital cycle has been very constructive for the natural resource space. And what I mean by that is that no one has really invested in this space for over a decade now. And we're starting to see the impacts on the supply side of the market really across the board, certainly in copper and in energy as well.
Hello and welcome viewers tuning in to our investor discussions. I'm very pleased to be speaking with Adam Rozencwajg, who is managing partner of Goehring Rozencwajg Associates. They're long-term natural resource investors with notably a compelling and contrarian outlook on commodities investing. So Adam, welcome. Thanks for taking time to have a chat with me today.
Thanks for having me this morning.
That's great. So you and your partner Lee have seen several cycles, and we're certainly into what some are saying is a super cycle. Maybe some people aren't comfortable with that term right now, but it's certainly a prolonged bull market that's on the cards. What's your take on it, and why could it be different this time around?
Well, I think what's fascinating about the current cycle, which in some measures you could argue began back in 2016, if you look at the price of copper, the price of gold, the price of the agricultural complex, and barring the lows made during COVID, the price of energy as well, all saw their lows in late 15, early 2016. So here we are, sort of 5 years into what has been sort of a nascent bull market, strong in the commodities, but not so much in the equities. And now I think that's beginning to broaden a little bit, and I think you're really starting to see a sustained move higher. And what's fascinating about this current cycle, which I think has been the reason that we've been bullish now for a few years and probably a little bit early, has been really two things, and they're joined. First, natural resources and commodities relative to really any benchmark that you like to look at. We like to look at the S&P 500 or the Dow Jones, became as cheap as it's ever been going back 120 years. And that has always been a wonderful time to be involved in the natural resource complex. The major market bottoms of commodities relative to financial assets occurred in 1929, 1969, and 1999. And if you look back on an absolute and relative basis, they were all excellent times to become involved in the natural resource complex. And so we had that signal again this time in 2017, 18. It kept making new lows all the way down because the S&P kept rallying, and finally made it, ultimate low in 2020. So I think you set up for this cycle right off the bat to be a very strong one to the upside.
Yeah, certainly. And that's on pricing. Are there any other factors at play? Do you subscribe to the ideas that, Biden with the infrastructure plans, governments chucking money at the recovery from the pandemic, that's just like throwing fuel on a fire? Is that accelerating it? Or has that been sort of equally behind a lot of the commodity upside?
Well, I think those certainly are all factors that will play into the bull market that we see unfolding today. But I think one of the major factors that you did not mention that I think is critically important is that the capital cycle has been very constructive for the natural resource space. And what I mean by that is that no one has really invested in this space for over a decade now. And we're starting to see the impacts on the supply side of the market really across the board, certainly in copper and in energy as well, in uranium emerging now too. And so I think that that's really kind of the second major leg here to the bull market story, is the fact that just nobody has put any replacement capital or new development capital into the sector for basically 10 years. And that typically sets up a major bull market due to a supply response. So I think that we have that waiting in front of us as well. On the demand side, per your comments, I think demand looks quite robust across the board. People have dismissed, let's say, metals demand into China now for several years. They always talk about China over-consuming. We don't think that's the case at all. The way that our models are calibrated and set up, we like to look not so much at what China demands every year, but how much total metal has been installed into that economy. It's a capital stock issue because, unlike energy, metals are installed. They're not consumed, so to speak. And so when you look at that measure, China's exactly where it should be for an economy of its size. And India is woefully behind. So you have these big demand drivers coming from the non-OECD world. And like you said, a second ago, you now have some fairly major deficit spending infrastructure bills proposed and in the process of being ratified in the developed world as well. So I think from the demand side, things look quite strong. Obviously, demand is always susceptible to a global economic shock and things of that nature, fiendishly difficult to try to predict. But I think in general, the demand story looks good, and the supply story looks even brighter.
Yeah, certainly. So that's great to get that macro overview. Let's pick out copper, as you mentioned it a few times, and I know that when you did something for us at a physical event quite a few years ago, you were talking up the bullish case for copper and actually, how many years it had been underinvested in, perhaps a decade of underinvestment prior. And you've run some models that see mine supply growth grinding to a halt this decade, pushing prices even higher still. Could you just talk us through your latest thinking on what copper is going to do in this decade?
Sure. So, I think that copper obviously has moved now. It's, well off its lows in the cycle. It reached $1.50 in 2015, and now it's made an all-time high above $4.50. It's pulled back a little bit here. So certainly, copper has moved. And I think what has changed in the last several years is basically a recognition of the very favorable demand trends. And I mentioned one of them a second ago, and that is demand coming from India and China and other parts of the non-OECD world. But another very important part of demand that I think has become better recognized, and frankly, I think it's been the major driver of copper's outperformance, has been copper's role as what's known as a green metal, so namely for renewables and for EVs and things like that, all of which are extremely copper intensive. And we wrote about that all the way back in 2015 and 2016. And nobody, I remember I did an interview, I forget whether it was with your affiliates or whether it was a different organization, but we talked about this concept of copper being instrumental for the renewable future, and nobody was talking along those lines. And so I think that's become better appreciated now. And for investors that are underweight the resource complex and have maybe some ESG concerns, I think it was a natural place to go when the bull market started. They said, "Oh my gosh, we can, we don't have to worry about, running afoul of investing in dirty companies. We can invest in copper companies, which actually are quote unquote green." So I think that is starting to become better understood by the market. I would also point out that, if I look at the different commodity stocks and subsectors, a lot of them have moved higher, but only one of them has seen real material inflows in terms of capital investment dollars, and that has been in copper. So I think that story is now sort of out there and is doing its thing. But what people don't fully appreciate is exactly what you mentioned, and that's the supply story. So, I think people feel that demand is there. That's what's taken copper from $1.50 through $4.50. And the bears will say, well, that's now going to trigger the right incentives to bring on new supply to put an end to the bull market. But I think what's really going to drive copper prices the next leg higher is the realization that that probably won't happen. And the reasons for that are several-fold. First of all, copper deposits tend to have a long lead time. They have 5 to 10 years from discovery to development. And if you look at the major discoveries, they really fell off a cliff beginning about nearly 10 years ago now. So to a certain degree, the sort of medium term is a little bit set in stone. We do have some new projects coming on next year. Ivanhoe has its DRC projects that are ramping up. So, we do have a little bit, but that's probably going to backfill depletion in other parts. But if you just look at sort of major new projects, we've never had so few coming online in the years to come. So then where can supply come from? Well, typically the other source of new supply has come from brownfield expansions during periods of high copper prices when companies have lowered their cutoff grade. So basically they've made their deposits artificially bigger, not artificially, but they've taken material that was deemed to have been waste rock and turned it into ore, and then they mined it, and that allowed them to grow production in response to higher prices. We argue that that's going to be more difficult this time, and it has to do with the natural distribution of grades amongst most porphyry deposits, which is the bulk of copper supply today. And basically, the idea is you've lowered your cutoff grade now already dramatically in the last run-up when copper went from 50 cents to $1.50 to $4 in this kind of range we've been in. You saw a lot of that from, let's say, 2002 to 2014. However, once you've taken the cutoff grade down far enough, there's not a lot more the material you can get by taking it down even farther. So, for instance, you've taken it down from, let's say, 0.8 to 0.4. That brought in a huge amount of new supply into mine plans. Taking it from 0.4 to 0, effectively saying, let's just get after the whole deposit, will actually bring in much less material than that other move. So it's a little bit counterintuitive. But when you look at how the grades are distributed, they tend to be log normally distributed, which means once you hit a certain low level of cutoff grade, further reductions have a very limited impact. Now, what's interesting is that 2014 to today, copper prices have been basically flat, with the exception of the last few months. And so companies have not had the advantage of being able to lower the cutoff grade. And unsurprisingly, their reserve additions have gone basically to zero on a net basis. So I think we have a little bit of confirmation that absent cutoff grade reductions, there's very little new reserves coming in, and I don't think we're going to get much from the cutoff grade.
Yeah, wow, that's an interesting, great point. So it's created sort of a perfect storm in terms of the scarcity of copper. Really, that's going to be around for this decade until that new mine supply can come online. But encouragingly, capital flows have moved back in, as you mentioned earlier, or certainly copper over other metals has seen a bit more of that capital flow. I just wanted to touch on your point around copper and ESG, or copper being sort of the green metal, and then in turn linking it to capital flows back into mining equities as such. Are you seeing, or do you feel that the investment community is still seeing mining as a bit too dirty to touch, even though we have this renewed understanding of battery metals, battery materials, copper as a essential part of everything that's electrified, for instance? It's a greener metal. Do you think that the ESG criteria is still holding back a lot of capital inflows to mining equities?
I do, and I think it's probably being lumped in a little bit with oil and gas, to form a natural resources complex. And if you look at the natural resources complex, that's definitely still, being impacted by ESG concerns and by capital flows there. I think it's beginning to change a little bit. May, I think, was the first month that we saw, fairly material inflows and, frankly, just a lack of outflows from the natural resource funds here in the United States. So I think that you're maybe beginning to see the first beginnings of a little change there, so that could be potentially promising. But yeah, no, I think that ESG is still front and center on a lot of people's minds. And I think what's going to happen as we go forward here is maybe we're going to have a little bit of a rethink of some of the subtler points of ESG. So if you think of kind of the first leg in ESG, that went from investors not really paying much attention to some of these factors to investors trying to stay away from areas they deem to be quote-unquote bad. I think maybe 2.0, if I'm being optimistic, says that perhaps we'll begin to have a more nuanced view around some of those things. I think if you're being more cynical, frankly, ESG is going to have to adapt a little bit because performance is starting to pick up in this space. And so I think it's one thing for to have an ESG mandate where agreeing to an ESG mandate helps your total returns, but it's quite another to have that stand as a headwind. And I think you're going to start to see investors begin to question the appropriateness of investment managers sort of investing with an ESG or a closet ESG mandate, if that's going to have a material negative impact on their total return. The other thing, though, that's happened, and I think that this is potentially the most important development that's happened in the last 90 days, and it doesn't revolve around the mining industry, but rather the energy industry. Exxon has had a minority shareholder, engine number 9, with 0.02% or 0.02% of the common equity outstanding, take 3 board seats on the Exxon board. Obviously, Exxon, the largest energy producer outside of Saudi Aramco, and at one point the largest company in the world. So to win 3 board seats with a de minimis investment, the way they were able to do that was by agitating for or engaging for less energy investment. And the reason they felt that they had grounds to take that view, I think, has to do with the fact that the International Energy Agency came out with the report saying if we're to hit climate goals, we can't have any sanctioned upstream major oil and gas projects going forward. Now, the way that this company was able to effectively get on the board was through a tacit approval by the passive index ETF holders of Exxon, which basically tried not to take an active view in sort of corporate policy matters and things of that nature. But given the fact that this company's agenda aligns with the IEA, who's the largest think tank in the world for energy, I think, provided a little bit of cover to say, okay, yeah, we approve that. So now all of a sudden you have a company with 0.02% equity ownership, controlling 25% of the board of what was the largest company in the world, with a mandate to basically stop producing oil and gas. And I think that is a material change in governance and in how these companies are now going to have to think going forward. And I think what it's going to do is it's going to make companies very reluctant to commit capital across the space out of fear that something like this could happen to them, or potentially it will continue to happen to other companies, and they'll actually be forced from the inside to restrain their capital spending. So I think to the extent that supply has been challenged, it's about to get a lot worse across the commodity complex.
Yeah, certainly. It's a really interesting development, the stakeholder management that's going to be required now. Yeah, I just had a point around Exxon. You've got your other oil majors, certainly the non-US oil majors, committing, albeit quite far down the line, to some kind of decarbonization plan or meeting the Paris climate agreements. And as far as I understand, Exxon hadn't done that, so they were very much in the spotlight. But this is the sort of the challenge that the oil majors or any oil companies are having to face at the moment with decarbonization. But then you look at the oil price at the moment, and we've had a good little run, and prices are rising. How do you match that up? Is that a case of just off the back of OPEC's issues, or a case of some of the other macro factors at play that's giving it a short-term burst? Or is because you're quite contrarian in this space, and have always been sort of making a case for where oil can be a good investment.
No, I think that oil has a substantial future in front of us today, and I think part of it is a misunderstanding of certain carbon drivers. I think others is a misunderstanding of the available alternatives and how clean they are, and so we could sort of jump into a few different things. But I think when people talk about oil, a major component of that, certainly in most people's minds, is personal auto transportation. And what I don't think people fully appreciate is that that represents 9% of global CO2. And if you look at even the most aggressive plans, they see EV sales, not total EV penetration, but EV sales reaching a majority or reaching I forget how they put it, a substantial amount, which I presume means over 50%, by 2035. And so you're talking about 15 years to get to 50% sales penetration, which would probably make it another 15 or 20 years after that to reach full EV auto penetration, not just sales penetration, to replace the fleet. So somewhere in 30 to 35 years from now, we will have addressed 9% of global CO2. But EVs are not carbon-free either. Particularly the mining of the battery metals is incredibly energy intensive, and the actual manufacturing of the battery is incredibly energy intensive. And there is very little hope that that's going to get really much better. I mean, some people talk about sort of next generation batteries, but the landscape has been littered with failed next generation batteries. I think one has to be very, very skeptical of particularly for automotive transportation purposes, where you're talking about high tech, very dense, so that they can overcome the weight issues and things like that. So, you're talking then about in 35 years addressing some percentage of 9% of the global CO2 problem. So if you actually care about CO2, you'll very quickly realize that that's not going to effectively cut it and make much of a difference. In particular, the alternative, often cases, and there's huge debate about this, and we've weighed in, people argue, how much cleaner EVs are. Our numbers say that an EV will become sort of break even with an internal combustion engine because of the battery, which is so carbon intensive, at around 100,000 miles, which is unsurprisingly approximately right around where an EV's lithium-ion battery is guaranteed to. So, that's, I think, a fair assessment is where the expected life of that battery could be. So you're basically talking about, something that at the tailpipe might have less carbon, maybe, depending on how the electricity is generated. Yeah. But when you factor in the battery and all of that, it's not much of a savings. Other people have said that the break-even point is lower at 30,000 miles, which I frankly have a very difficult time getting to, and I think most people that say that assume that all of the electricity, including every mine fleet in the world, is powered by carbon-free electricity, which is simply just not the case. And on the other side, I've heard people say 600,000 kilometers on an EV before it breaks even. I think that that's probably a little bit off the mark as well. But that's, I think, when you look at both the alternative to oil, which is not particularly carbon friendly, and the difficulty in sort of rolling that out, both from a battery metals perspective and a manufacturing process perspective, I think that the hatred around oil and gasoline is a little bit misguided. I think there's other things that we could be doing to have a much bigger impact. The steel industry, for instance, is making big strides towards carbon-free steel. Just to put that in perspective, carbon-free steel would represent more of a carbon savings than if we replaced every car on the planet with an electric vehicle. So I think, it's good to see the industry going after that. I think uranium and nuclear power is critical to a decarbonization future because it's the only source of carbon-free baseload electricity. It's incredibly energy efficient. It's incredibly carbon efficient. And why we're not, approaching that from all angles is beyond me. So those are the types of things that I think will have an impact. I think, switching out from coal to natural gas where possible would have an immediate impact on improved CO2 emissions. And so that tends to be where we like to invest. We're invested in natural gas. We're invested in oil because there's just so little capital going into it that it's creating the investment opportunity of a generation. We're invested in copper on the electrification theme, and we like uranium as well. So, I think that it's not that we don't think that carbon mitigation is a theme. I just think that the way people are going about it doesn't make any sense at all.
Yeah, fascinating. And it does make a lot of sense when you look at the sort of the scale of the energy transition and the speed at which governments or policymakers are expecting this to come into play. And your point around the penetration of the electric vehicles as well. Just touching on your point then about uranium and then looking at the sort of energy mix, do you see the sort of the cleaner future with sort of the society getting back on board with uranium as the baseload power? Are you sort of, do you have a similar lack of faith in renewables, or do you think that there's a harmonized response that needs to come, or are we simply not going to get there at the current rate?
Well, I can start with uranium, and quite frankly, the uranium story is a very bullish story, having nothing to do with the decarbonization future. If you look at how little has been invested in that space now for longer than really 10 years, probably almost 20 years, and if you look at the expected rollout in the non-OECD world, there's a very, very bullish story there. Frankly, that probably started two years ago. People that follow us will know that we tend to be early on things. So we started our uranium investment 2 or 3 years ago. We were probably a little early there. But, it's been a good performer. But now I think the fundamentals get very, very good in a hurry here because of these new reactors being brought online in the non-OECD world, particularly in China and some in India as well. So I think that is incredibly bullish in and of itself. When you look on the supply side, I've never seen a commodity market where the price of the commodity dipped below the flagship, incumbent's cash cost of production, and where the price needed to incentivize the next generation of uranium mines was, 200% out of the money at the bottom, maybe 300% out of the money at the bottom. I've never seen that before. Normally, as your listeners will know, if a commodity, if copper prices get to within the 95th or 90th or 85th percentile of cash costs of the industry, that tends to be a pretty decent floor. I've never seen it get all the way down to the incumbent flagship operations in the world, but that's what happened with uranium. So, that's just an incredibly bullish supply side story as well. I think where the green side of nuclear will have a big impact for investors is on the perception side and on the investor psychology side, because remember, uranium is an incredibly small industry. There's really 2 producing companies and, a handful of development stories, frankly, most of which I think have a difficult time working at lower than $75 uranium. And so if you start to get capital coming back into that space on a sort of a green psychological shift, I think that's going to be a material driver of the stock price, not necessarily of the fundamentals. And then on the medium term, from a decarbonization perspective, I'm hopeful that we do begin to appreciate the huge potential that nuclear energy can play in the energy mix. It's been around a long time. It's never cracked 10% of power. Of the energy mix, rather, but there's no reason it shouldn't. It obviously is plagued with a safety issue. I think if you look statistically, nuclear power is very, very, very safe. I think it's the safest form of electricity that we generate. However, it has been punctuated by a few sort of large major events. Really the only detrimental one, frankly, was Chernobyl, and you could make the case that was more of a weapons manufacturing facility than it was a electricity generating facility. I don't think anyone in their right mind would build a reactor like that today. But having said that, it definitely has a PR problem, and I hope that that'll change over time.
I wanted to ask, what's the incentive price for companies to start producing uranium again, and also as a secondary to that, where's the good investment case now? Is it in some of these uranium juniors that are there with good operations waiting for that price just to kick on to the next level? Are you telling investors that uranium equities are a buy right now?
Yeah, it's a great question, and I think in order to get a little bit of perspective, I'll tell you how we manage the portfolio. So first of all, the incentive pricing, there's two incentive prices that are important in the uranium market right now. The first would be the incentive price needed for Cameco and Kazatomprom to bring back on some curtailed production. And the second would be the incentive price to bring on new projects from the development, mid-cap juniors and stuff like that. Focusing on the second, I think that in order to bring on new supply, you're really talking about $75 uranium prices. So, double, a little more than double where they are today. I think if you look at some of their PEAs and PFS studies, that number might be a little bit lower. Certainly on a cash cost basis, it's lower, but in order to generate a 10% rate of return, it needs to be a bit higher than that. And I think for the banks to finance these projects, you're going to need 75 for a sustained period of time before they'll really begin to look into that, just because this has been such a bad bear market and it's lasted so long. And uranium is a fairly small niche industry, so I don't know that you have many banks sort of rushing in to lend to the uranium space. But as far as whether we recommend the junior companies or not, I think, again, let me explain how we like to manage the portfolio. So we start by trying to take an active view on where we think commodity prices are going. Once we do that, we plug those higher commodity prices or lower into our company-specific models to see what each company's value ought to be if we're right on the commodity price. That forms our price target and our upside potential. But what we also try to do is we try to manage what's going to happen if we're wrong on the commodity price and it goes against us or goes the other way. And what we're looking for is companies, maybe their share price won't do well, but they won't go out of business. And there still is some value there, and they won't materially and permanently impair capital if we're wrong on the commodity price. So in the case of a Cameco or a Kazatomprom, if uranium prices went back to 19 or stayed at 30, maybe the stocks sort of trade sideways, certainly down if uranium prices fell again. But they're the incumbents, and they're generating cash. And to the extent we're ever going to have a uranium industry, Cameco is going to be around. So you're not going to permanently impair that capital. There's not a lot of debt there, and so I don't think there's a major risk of financial difficulties. On the other hand, some of these development stories, if uranium goes to 75 like we think it can, or 100, they're going to go up tenfold. But if we're wrong on the uranium price, those companies are sort of, worth whatever the cost of their PFS cost, to produce. And so as the uranium price seems like it's going to more sustainably trade in that higher region where some of these projects will come in the money, I think you can start to look to deploy capital into some of those development names, but I think it's a bit early yet. So the way we've handled it, we've invested in one of the development stories. That's Next Gen. I think that when we rank them, looking at different metrics, we think that it's the most promising of the junior development stories. It's entirely possible we're a little bit early, It's entirely possible we were a little bit late too, because we didn't definitely pick it up at the bottom. But that's it's a little bit of art as well as science. So I think we're cautious on some of these stories that do require much higher prices, but we're going to sort of leg in as we think this bull market looks more and more sustainable. And maybe that means we leave a little on the table, but that's how we like to invest.
Yep, absolutely, excellent. That's really clear and good to get a good overview. And I guess with uranium, it's often been said, it's not if but when, and that's the art element to it, as you mentioned.
Yes, unfortunately, they've been saying it for a long time, but there's some truth to it.
Indeed, and of course, so just for the viewers, you publish a lot of your research through a newsletter or investor note that we've always been a fan of, one-to-one, and that's free for people to sign up to on your website. But of course, investors can get involved or sign up to your funds through further conversation. I guess they can reach you through the usual channels.
Yes, that's right. We have a mutual fund available to U.S. clients. We also, have institutional separate accounts available as well. So I would recommend anyone that has interest to please go to our website. Please reach out. But a lot of people do know us from our letters because, and this goes back to the mid-'90s, we've always written extensively on what it is that we're doing. We do it as sort of a bit of an audit trail to go back and review our thinking, because sometimes we'll ask our partners and our investors to really look forward and sort of stick with themes and trends that don't seem like they're working for some time. And unless we really explain what we're doing all the time, I think that level of trust is too much to ask of people. So we like to spell everything out. You can go back, see what we got right, see what we got wrong. We leave everything up there. So, even our bad calls are there. And so please do take a look and reach out if you have any questions.
Adam, thanks very much for speaking with us today. That's Adam Rozencwajg of Goehring Rozencwajg Associates. Thanks for taking time to chat with us today.
Great. Thank you so much.